All right, welcome back everybody. My name's Austin. The U.S. economy in 2020 has changed. Whether you're investing in stocks or gold or Bitcoin, things have changed. Now, I'm not a financial advisor. I can't see the future, but watch this whole video. Especially if you're a relatively new investor, this is something that new investors don't know. If you're a seasoned investor, if you've been in the space more long term, then you know this. Watch this video and double check my work. Because this is something that the mainstream, despite their best intentions, this is something they won't tell you. Basically, what this all comes down to is that major US banks like JP Morgan, like Goldman Sachs, are signaling to the mainstream media, who are signaling to you, that the stock market is back in session. We are officially, year to date, although we are still in red, year to date, we are a mere 6% away from crossing and surpassing all-time highs in the stock market. In fact, major banks just came out with new numbers giving their projections for the end of 2020. And in the headlines, right from Forbes, a recent jobs report shows big May employment gains, meaning that unemployment is falling. And just getting into the exact numbers, payroll reports for this last month show a surprising gain of over 2.5 million more people employed, over 2.5 million more people now on a payroll, showing that jobless rates or unemployment rates have fell to 13.3% after analysts for the last 2 months expected May to have nearly 20% unemployment. It's really 13.3. And by the way, I'm not accusing these headlines of being misleading. They're just facts. I mean, unemployment rates are going down, employment rates are going up. What I do want to talk about is consumer demand and consumer spending in the United States in 2020. As well as look on a more macroeconomic time frame for investors in the United States and abroad. But first, let me share with you how the mainstream reacts to this recent May job report statistic and watch them share Goldman Sachs projections for the end of the year for 2020. Watch this.
Monthly jobs gain has some economists rethinking their outlook for growth in the second half and the potential for an even faster rebound. Steve Leisman and the Lease Maniacs joins us now, which is, I think, a better name than the Muckrakers, which is what you've been going with for a while. But just think about that, Steve. Anyway, tell us about that number.
Yeah, Joe, that surprise number from Friday really echoing through the weekend all the way to today as you see the futures in a positive mood this morning. And what it's done is it's caused economists to think, you know what? Maybe there's some upside to the disaster that had been forecast. They're still forecasting very negative numbers, but now they're starting to think about upside risks to their forecast. Take a look at what Goldman wrote over the weekend. Quote, "We expect growth data in the U.S. and Europe to turn more clearly positive in the coming weeks." One of the things that they did is they lowered their outlook for unemployment for the year end to 10%. So still a terrible number, but a better number than they had in the forecast. JP Morgan writing, the latest employment numbers reinforce the sense of upside risk to the second quarter. Now, I want to show you a little curtain raiser on the Fed survey we'll have for you tomorrow.
Okay, I'm going to like it. I'm going to support it, but now let's analyze it. We see in Q2 of 2020 negative growth projections, although we are halfway through Q2 at the moment. By the end of this year, in Q4 of 2020, we'll be in the positive. We will be growing again. The banks, signaling to the mainstream media, signaling to you, expect a faster economic rebound and growth for the second half, and that's awesome. And believe me, in the short term, if we can go up another 6%, if we can cross all-time highs, tremendous upside in the short term. But in the long term, and this is what more seasoned investors understand, in the long term, the party is coming to an end for a while, and I can prove it. I can prove it to you, because look at this. It's all cycles. The S&P 500, traditional markets, cycle on and off with gold. When the S&P 500 breaks, has a run, gold sort of levels off, and then when the S&P 500 starts tanking, investors, macroeconomic investors, look for a harder asset, like gold, now like Bitcoin, to store their wealth. And even though we're seeing traditional markets thrive right now, the consumer demand, the purchasing power from the consumer in the United States is nowhere near what it once was. The civil unrest in this country is near all-time highs. The wealth gap between the ultra-rich and the ultra-poor is widening. And the first time in a long time, in about a decade, we have the statistics to back it up. The United States consumer spending. This is the consumer spending for the last 3 years. And in 2020, consumer demand in the United States decreased to about 13,180 billion USD. In the first quarter, it decreased to that from 13,400 to 13,100 billion dollar USD from the fourth quarter of 2019. When was the last time in the history of United States consumer spending that we saw the start of this trend change? Well, we're at the 3-year. Let's go to the 25-year. The last time we saw this trend change was, yes, during the housing crisis of 07, 08, and it lasted about 2-3 years until we started working back up. And it will go back up. But what is the smart money doing? Even if it's not 100%, what if just 5 or 10 or 25% of these macroeconomic investors, what are they doing? Well, they're realizing that the party, maybe it's not over today, maybe it's not over till next year, but the party is closer to ending than thriving. And they're looking for a harder money, like gold, possibly like Bitcoin, which I believe is a harder money, which macro investors like Chamath Palihapitiya, like Paul Tudor Jones, are signaling that they believe that Bitcoin is also a harder money. Eventually, the S&P party comes to an end, and when that happens, gold thrives. If we don't see that spending come from the consumer side, that consumer spending, judging by history, it's the beginning of the trend change. Let me know what you think down below in the comments. As we get more information, as we get more data, I will keep you updated. But next piece of Bitcoin news. Bitcoin's average transaction fees fall by 83% from post-halving highs. So fees are back to normal. And the fear was, right after the halving, the fear was, just weeks ago, there were fears that miners had begun to capitulate, Bitcoin blocks were slower than normal, transaction fees skyrocketed, and data analysts observed large outflows from miner wallets, meaning miners were selling. What's very interesting, though, is Bitcoin's price, it didn't really move. In fact, Bitcoin's price, despite that quote-unquote miner capitulation, Bitcoin's price kept increasing. And we waited it out, and fees are now back to normal. But the question is why or how? How did fees return back to normal? Well, in the last couple days, couple weeks, there are now enough miners to process transactions. And the proof that more powerful miners have since come online is evidenced by the skyrocketing hash rate on the Bitcoin network over the last couple days. Let's check it out. This is Bitcoin's hash rate. We immediately saw a drop when the Bitcoin had its halving. It was half as profitable. But the interesting thing is, we are popping back near all-time highs for hash rate. And a big reason why is, for Bitcoin, and this channel will tell you, after a 10% difficulty drop, Bitcoin miners are back in the game. So the difficulty adjusted 10%, which is huge, and that is very bullish for Bitcoin. On June 4th, the latest adjustment hit, resulting in a negative 9.29 difficulty adjustment, so it's about 9% easier for miners to mine. And in Bitcoin's history, this is the 7th largest difficulty adjustment down ever, and the 4th negative adjustment since the start of the year. So because of this, what happened? Well, miners were quick to turn on their machines, responding to the difficulty adjustment, effectively a short-term boost to their profitability. And final piece of news, Block One, the company behind EOS, is launching their social media platform Voice ahead of schedule. It will be open for business next month on July 4th. This is only for people that pre-registered already, and you're going to be able to invite friends on the platform after August 15th. So I'll keep you posted. I'm a little leery because Dan Laramere, the guy behind Block One, also created Steemit. Steem, to me, that never really took off past the crypto community. And if I'm on a social media platform, I want the world to be on it. But keep in mind that Voice has come under fire for privacy concerns, and all members will have their identities verified with some metadata used to prevent and detect crime. So you will have to, KYC in some aspect your identity to use the platform. But anyway, that's the video. My name's Austin. Like always, see you tomorrow.